Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Lots of talk these days about huge demand for capital on the part of companies, especially those participating in the fourth industrial revolution, otherwise known as AI. We'll have more on that in a moment. And their governments who are funding what seems to be an ever-increasing debt burden. This week, we stumbled upon an interview with Eric Cantor, former Majority Leader of the House of Representatives, now a Vice Chair of Moelis. He was asked, "Do you think corporates are competing for capital with the government?" He responded, "I don't think there's any question. This incredible infrastructure surge around data centers, every conversation we're having at Moelis is somehow downstream from this cycle." This week, our three things are: 1. Caterpillar earnings, a blowout, but what does it say about the AI story? 2. Data center dimensions, driver of the broadening out. And 3. Bonds as a hedge, checking in on correlation. All right, let's dig a bit deeper. Caterpillar earnings. Now, we don't often get too animated about Fortune 100 multinationals, but Caterpillar Inc., yes, CAT, is worth highlighting. We all know CAT for its yellow iron construction equipment, but it also manufactures gas engines and turbines and locomotives. And it turns out it's a big player in data centers. Data centers have become a meaningful growth driver within the company's power and energy segment, and that segment accounts for about half of its revenue. CAT's business is booming. Adjusted Q2 earnings grew 54% year-on-year on sales growth of 24%. CAT beat its estimate by 24% and raised its full-year sales outlook. The order backlog is up 92% from a year ago. So what has the stock done lately? Well, it sold off 24% in July. This is not some off-the-run opaque company. Granted, the stock had been up 86% through June, and its forward multiple had risen to double its long-term average. But still, what drove the downdraft? Well, CAT has become a picks and shovel AI beneficiary, something that fashionably drove its valuation far above that of its traditional classification as a cyclical industrial. Recent concerns that data center growth could slow clearly let some air out of the name. Now, it's worth mentioning that credit markets were not spooked. 5-year CDS at 19 basis points has traded down toward its 20-year low. So we're not worried about CAT credit. Instead, we're on the lookout for signs that the AI promise is weakening. And there is no sign of that in CAT's earnings. Power generation grew 72% year over year, driven by, quote, very strong demand for large gensets and turbines used in data center applications, unquote. Looking ahead, management sees strong demand in power generation to support data center build-out related to cloud computing and generative AI. Data center development is also driving demand for construction equipment. Management added, "We have constant discussions with our customers, and all I can tell you is no one is slowing down at the moment. In fact, if we can get more units out, they're asking us to give them more units." The fact that data center construction continues at breakneck speed is not all that surprising given all the capital that has been raised. But as one of the more significant growth engines in the economy, the color is reassuring and certainly good for credit. All right, on to our second thing, data center dimensions. It's hard to get your arms around $7 trillion. That's McKinsey's estimate for data center build-out through the end of 2030. At roughly $1.4 trillion a year, that represents about 20 to 25% of the total annual U.S. private domestic investment. The Caterpillar story reminds us that many firms participate in the build-out. McKinsey envisioned about 60% of total spend would go to chips, servers, networking, and storage. Another 25% would go to power generation, transmission, and electrical infrastructure. Then there is 15% allocated to data center buildings and mechanical systems. So yes, that's a lot of economic growth coming from one narrow sliver of an industry. But the reality is many industries are involved in the data center build-out. Direct participants, that includes chips, servers, power, data centers, number about 50 or so firms of the S&P 500. Major suppliers, that would include electrical, industrial, construction firms, that numbers of another 100. And firms indirectly involved, that would be software, cybersecurity, utilities, real estate, include another 100 firms. So call it 250 firms, half of the index by count, are involved in the data center story. When we talk about a broadening out of corporate earnings growth, you can see how the data center story contributes. We are also cognizant of the role hyperscalers play in all of this, and that's where the concentration risk is evident. Somebody has to pay for all this. If we look at consensus estimates for the big five hyperscalers, that's Alphabet, Amazon, Meta, Microsoft, and Oracle, we see that four of the five, all but Microsoft, expect to be free cash flow negative in 2026 and 2027 as CapEx soars in the AI arms race. Now, given the balance sheet strength, competitive positioning, and strong operating cash flows seen in the group, we are less concerned about the leveraging up among the strongest names, nor the pace and magnitude of near-term returns. The more significant issue for credit markets, in our opinion, is twofold. One, just how much debt in all of its forms is coming and at what pace. That would include unsecured debt, secured debt in the U.S., outside the U.S. debt, off-balance sheet debt. And two, foreign competition in the AI race. One thing we are sure of, the build-out over the next 5 years will not be a straight line. All right, on to our third thing, bonds as a hedge. So we've liked the relative value of high-quality credit as rates have reset. Bonds' income and diversification attributes have appeal once again as ballast in portfolios against frothy stocks and an uncertain future. In other words, the traditional argument for the 60-40 portfolio, with bonds as a hedge. In an environment where there is a growth scare, usually accompanied by low inflation and the prospects of central bank easing, bonds make a lot of sense. This was the environment in the period from the GFC to COVID, and correlation between high-quality credit and stocks was overwhelmingly negative, averaging minus 0.29 over that period. But what if the opposite is true? What if you had trend growth at or around 2%, sticky high inflation, and an outside fiscal deficit? All of a sudden, bonds might not make as much sense. And that is what we're seeing now and what we've been seeing over the past 5 years or so. An environment where the correlation between stocks and high-quality bonds is not negative. In fact, it's positive. And in fact, correlation recently has broken out to the upside with a 0.65 coefficient. So what's behind this move? It's inflation risk premium and debt and deficits. It's the prospect of fiscal dominance that shows up in two ways. One, a supply surge. It's increased Treasury new issue to fund deficits, keeping upward pressure on rates. And two, a rising inflation premium, stemming from two megatrends: rising government spending, as well as a world that is moving away from a lowest cost model to one that prioritizes, and pays up for, security of everything. From an investing standpoint, it means that high-quality bonds are a less effective hedge than what was the case in that low-growth, low-inflation period post the GFC up to COVID. Now, we still believe investment-grade bonds returning north of 5%, that's real returns of 2 to 3%, are attractive in an absolute sense. But if you're allocating more to high-quality bonds as a shock absorber, you may be disappointed. So there you have it. 3 things in credit. 1, Caterpillar earnings. The AI promise remains intact. 2, data center dimensions. It takes a lot of sectors to build out this infrastructure. And 3, bonds as a hedge. We like investment-grade yields at these levels, but hedge value has weakened. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.